There's a couple in Toronto, Ontario, named Doug and Carol. He is 69, she is 66. Last spring, they sat at the kitchen table with both of their tax returns spread out side by side, and they did something most retired couples never do. They compared this year's numbers to last year's, line by line, for both of them at once, and they found something that did not add up. Their combined income was almost identical to the year before. Their deductions looked the same, but their combined tax bill had dropped by several $100s, and their combined OAS had crept up, and neither of them could explain why. They had not done anything differently, had not earned less, had not found some clever new deduction. What had happened was this. While they were living their life, the rules underneath them had quietly shifted. 5 of them, not announced with a letter, not explained on the news. Just numbers on a page that moved silently. In most cases, putting money back in their pockets, and in one case, setting a trap neither of them knew was waiting. Doug and Carol got lucky. They caught the difference because they happened to look. Most retired couples never look. They hand their slips to the same preparer, sign the same 2 returns, and never know the ground moved under their feet. Today I am going to show you the 5 rules that changed for Canadian retirees this year. One's Doug and Carol stumbled onto by accident. 2 of them quietly hand the couple money. 2 of them are tripwires that punish you if you cross them without looking, and one of those 2 works differently for a couple than it does for a single person, which is exactly why this matters. And one of them ends a fear that drove retirees into expensive mistakes for 2 years. By the end, you will know all 5 and exactly what to do about each one as a couple. This video is for educational purposes only and is not tax, legal, or financial advice. Everything here is based on current Canadian tax rules and public information. Your situation is your own, so confirm with a professional before you act. In this channel, we break down the CRA rules, the financial traps, and the strategies that protect Canadian retirees from the things nobody else explains. If that sounds like something you need, hit the like button and subscribe right now, and turn on notifications so the next change does not slip past you. Drop a comment right now. Have you and your spouse ever sat down and compared both of your tax returns side by side, the way Doug and Carol did? Yes or no? I rate every single one. Let me answer the question already forming in your head. If these changes help retirees, why does nobody tell us? The answer is uncomfortable, but it is not a conspiracy. The government has no obligation to help you pay less tax. When a change benefits you, nobody profits from making sure you know about it, so it lands as one line in a budget document nobody reads. When a change can hurt you, the responsibility to track it falls entirely on you. The changes that help you stay quiet. The changes that can hurt you wait patiently for you to make a mistake. That's the whole pattern. And the only protection is understanding the numbers yourself. So let me group these 5 the way they actually behave, because that is more useful than a random list. First, the 2 that pay you. Then the 2 that trap you. Then the 1 that frees you. The first one is the rate itself. For all of this year, the lowest federal income tax rate dropped from 15% to 14%. This is the rate cut that took effect partway through last year, which means this is the first full calendar year where every dollar in the first federal bracket gets the lower rate. 1 percentage point sounds like nothing. Here is why it is not. The first federal bracket covers income up to roughly $58,500. The lower rate applies to every dollar inside that band. For a retiree with $50,000 of taxable income, that is around $500 saved a year, automatically, with no form to file. For a couple, where each of you might be sitting in that same bracket, that is potentially $500 each, close to $1,000 saved between you every year without lifting a finger. But the rate cut has a second effect that is easy to miss, and this is the part that compounds. 14% is also the rate used to calculate almost every non-refundable credit you claim: the basic personal amount, the aid amount, the pension income credit, the medical expense credit. All of them are multiplied by that rate. The biggest of those, the basic personal amount, rose this year to $16,452, the slice of income each of you earns completely free of federal tax, and the highest it has ever been. For a couple, that is to basic personal amounts, shielding just under $33,000 of household income before cent of federal tax applies. That is the first thing that quietly put money in Doug and Carol's joint pocket. A lower rate and a bigger shield, working twice over because there are 2 of them. And there's one more thing worth saying about that rate cut, because couples underestimate it. 1 percentage point does not sound like much in any single year, but retirement is not 1 year. Farfi Raich in your mid to late 60s today, you may both be drawing income for another 20 to 25 years. That 1 point, applied every year, to every dollar in that bracket, for both of you, compounds into many thousands of dollars over the life of a joint retirement. Doug and Carol felt 1 year of it. Full value is decades of it, stacked, times 2. The second rule that pays you is one you each earn individually, the day you turn 65. It is called the age amount, a federal credit available only to Canadians 65 and older. This year, the base amount rose to $9,208. At the 14% rate, that is worth up to $1,289 in federal tax savings per person. Add the matching provincial age credit, and the total reaches somewhere around $1,800 to $2,000 per spouse, depending on the province. Here is where it matters more for a couple than for a single retiree. If both of you are 65 or older, you each claim your own age amount. Doug, at 69, and Carol, at 66, both qualify. That is 2 age amounts, potentially $3,600 to $4,000 a year in combined savings, simply for being the age you both are and filing correctly. If one spouse is still under 65, only the older spouse gets it for now, and the credit shows up on one return instead of 2. Either way, it is worth checking that both of you are actually claiming it the moment you are each eligible. Software does not remind you the year you turn 65, and that is the second pile of money. So far, so good. But the age amount is also where the first trap hides. The age amount does not stay full, no matter what. It is income tested, and this is the part that surprises couples. It is tested on each spouse, his individual net income, not your combined household income. The moment your net income climbs above roughly $46,432, your age amount begins to shrink. For every dollar above that line, you lose 15 cents of the credit, until it vanishes entirely a little above $107,000. And it is calculated separately for each of you. Here's why that matters. Most retirement income comes out of a RRSP, and every dollar pulled from a RRSP counts toward net income, your individual net income, on your individual return. So if Doug's RRSP withdrawal pushes his income over $46,432, his age amount erodes, regardless of what Carol's income looks like. The two of you can have the exact same combined household income, but if it is lopsided, say, mostly sitting on Doug's return, he loses credit that the two of you, structured differently, could have kept. For Doug and Carol, combined CPP and OAS bring in about $46,000 a year between them, and modest RRIF withdrawals on top of that put their combined income around $96,000, split close to evenly because they have structured their pensions and withdrawals to land roughly $48,000 on each return. Afis Piki sheaf them just over the $46,432 line individually, so both of their age amounts are partially eroded, but only partially, because neither of them is carrying a disproportionate share of the household income on their own return. The retirees who understand this calibrate not just how much they withdraw, but whose account it comes from. Couples who do not watch their combined tax bill creep upward year after year, and never connect it to the fact that one spouse's RRIF is doing all the heavy lifting. The second trap is bigger, and it is the one that does the most damage. It is the old age security clawback, officially the OAS recovery tax. Once your net income climbs above threshold, the government takes back your OAS at 15 cents on every dollar over the line. Go far enough over, and the whole payment disappears. This year, that threshold rose to $95,323. That increase is genuinely good news. It gives you more room before the clawback bites. But you have to understand the mechanic, because it is one of the cruelest in the whole system. It is a 15% surcharge stacked directly on top of your regular tax rate. Cross that line, and the real cost of the next dollar of income can push past 50%. Now here's the part that matters specifically for a couple like Doug and Carol, and it is good news for right now, and a warning for later. The threshold is per person, not per household, as long as a couple splits their income evenly, the way Doug and Carol do, with both of them sitting around $48,000 of individual net income. They each get their own threshold, and both of them are nowhere near it. Right now, their full OAS is safe. That is the protection an intact couple has that a single retiree does not. But that protection is conditional, and this is the part almost nobody plans for while both spouses are alive. Picture a couple, both around 70, who have done everything right, income split evenly, both comfortably under the threshold, full OAS 4 years. Then one spouse passes away. The surviving spouse inherits the other's RRIF, rolled over tax deferred, which is the humane part of the rule, that larger combined RRIF now generates larger mandatory withdrawals, and those withdrawals land on a single tax return against a single threshold. The income that used to be shared between two people is now concentrated on one. The surviving spouse, in the hardest year of their life, crosses the clawback line and watches part of their own OAS kicken back, on top of losing the ability to split pension income, on top of moving into a higher tax bracket as a single filler. This is exactly the structural risk sitting quietly underneath Doug and Carol's plan today, even though everything looks fine on paper right now. It is not rare, and it is almost never explained in advance. The defense has to happen while both spouses are still here, drawing down the larger RRIF more aggressively now, while both thresholds are still available to use, and shifting some of that wealth to IFSs, where it will never count against either of them, including whichever one of them is, eventually feeling alone. Now the fifth rule, the one that frees you, because it is the answer to both traps and the most quietly powerful change of all. For 2 years, a fear hung over retirees, with cottages, rental properties, and investment portfolios. The government had proposed raising the capital gains inclusion rate from 50% to 66.67% on larger gains. The proposal sent a wave of panic through the retirement world. People rushed to sell cottages early, to lock in the lower rate, while they still could. Many retirees paid tax years earlier than they needed to, out of fear of a change that had not even been finalized. And then, quietly, it was cancelled. For now, the inclusion rate stays at 50%. Not deferred, not coming back through a side door, abandoned. Doug and Carol have a small cottage in the Muskoka, bought decades ago and held jointly. In the middle of the scare, their first instinct was to sell and lock in the lower rate before the change hit. Here is something worth knowing, even though the fret is gone. Because the cottage is jointly owned, the gain on a sale would have split roughly in half between the two of them. The proposed higher rate was only ever going to apply above $250,000 of gains per individual, per year. So even in the scenario they were afraid of, joint ownership alone would have shielded them more than they realized. They did not know that at the time. They just knew they were scared, and almost sold. Had they gone through with it, they would have triggered a gain years before they needed to, and paid tax on money they did not need to touch. Because the proposal was cancelled, that mistake never happened. That single avoided sale is worth more than every other change in this video combined. That removes the panic. But the part that actually frees you going forward is the other tool that quietly grew this year, and it is the direct answer to both traps we just walked through. The tax-free savings account. The TFSA annual limit is $7,000, and the cumulative room for someone eligible since it began who has never contributed is now $109,000. For a couple, that is $218,000 of combined room. Here's why it is the single most important tool in this video for a couple specifically. Remember the two traps. The age amount phases out on individual net income. The OAS clawback hits on individual net income. Money pull from RRIF counts toward both, on whichever spouse's return it lands. But money pulled from a TFSA does not count toward either for either of you. That means every dollar of household spending you can shift from RRIF to either spouse's TFSA is a dollar that does not push that person toward their age amount phase-out, does not push them toward the OAS clawback, and does not raise the household tax bill at all. It also means the TFSA is the tool that pre-funds the survivor's trap defense we just talked about. Money sitting in either of your TFSs is money that will still be invisible to the CRA the day one of you is filing a loan. Most couples treat their TFSs as a place to park spare cash. The ones who understand these 5 rules treat their 2 TFS as together as the master switch that controls every threshold in the household's tax picture, both now and for whichever one of you outlives the other. Let me make this real with numbers, because grouped together, these 5 rules are worth far more than they look one at a time. Doug and Carol have combined CPP and OAS of about $46,000 a year. A RIF of $300,000, mostly in Doug's name, and $150,000 in Carol's. and TFSs of $55,000 and $70,000 respectively. With modest RRIF withdrawals layered on top, their household income sits around $96,000, split close to evenly. Watch how the 5 rules play out for them. The rate cut and the higher basic personal amounts quietly trimmed several $100s off their combined federal tax. The difference they noticed but could not explain. Because both of them are over 65, they are each claiming a full age amount, worth well over $3,500 combined, partially reduced because both sit just over the $46,432 line. But by structuring withdrawals to land evenly across both returns, instead of loading one spouse's RIF, they are keeping more of it than a less even split would allow. Because they split their income evenly, the OAS clawback threshold of $95,323 is not a current concern for either of them. Both are comfortably under it on their individual returns. But the survivor's trap is the one item on this list they have not planned for yet, and it is the one that will matter most the day either of them is filing loan. The cottage scare cost them nothing in the end, because the proposal was cancelled. And because the cottage is jointly held, even the scenario they feared would have hit them less hard than they assumed. Then there is the TFSA, where the real strategy lives. In a year when Doug's RRIF income is already close to his age amount line, instead of pulling more from his RIF, the couple draws the difference from Carol's TFSA. Instead, money that funds the exact same household expenses, but counts toward nobody's income, erodes nobody's credit, and threatens nobody's OS. By using their combined TFSA room as a control valve between the two of them, they keep both individual incomes lower, preserve more of both age amounts, and start building the TFSA cushion that will protect whichever of them is widowed first. Conservatively, that coordination is worth another $2,500 to $3,500 a year between them. Added up, in a single year, Doug and Carol are protecting somewhere between $6,000 and $8,000 through deliberate use of these 5 rules, plus the one-time avoidance of a cottage sale that would have cost tens of thousands. Over a 20-year joint retirement, the recurring savings alone compound past $130,000 on an entirely ordinary couple's numbers, simply from understanding 5 rules that moved quietly and planning around them together. That is why our financial planners at Ontario Wealth Strategy Experts helps retirees in Ontario build a tax-efficient withdrawal plan. What they do is initially, we build a financial plan, and on a yearly basis we will do tax projections based on tax rates, deductions, and credits based on that year, so that when you and your spouse sit down with your accountant, you already know how the rate, the age amount line, the OAS clawback line, and your combined TFSA numbers. For both of your returns, not just one, you are being proactive with your tax planning and are in control. But for within Ontario, do not want to do all that we talked about today by yourself and would rather work with a professional for your tax planning and investment management. Scan the QR code or click the link in the description to see if we are a fit. I can already hear the objection. But we are not sitting on $450,000 between us. We do not have a cottage. Does this still apply to us? More than ever. And here is the counterintuitive reason. The lower your household income, the more devastating it is to lose a benefit you were entitled to. A wealthier couple who loses part of an age amount barely notices. A couple living more modestly, who triggers a clawback of an income-tested benefit because they did not understand how one spouse's RIF withdrawal interacts with the threshold, can lose a real share of their entire annual income. For a lower-income couple, the 5 rules just play out on a different stage. The rate cut and higher basic personal amounts shield more of your modest combined income entirely. Age amount is a bigger share of the little tax you owe. The OAS clawback may never reach either of you, but the guaranteed income supplement absolutely can, and it is even more brutal, clawing back 50 cents of benefit for every dollar of RIF income from the very first dollar. Unimportant difference for couples. GIS is tested on your combined household income, not on each of you individually, the way the OAS clawback is, which makes it even more important to know exactly where your joint number sits, not just your own. The same TFSA strategy that protects a wealthier couple's OAS protects a modest couple's GIS. If you are living mostly on CPP, OAS, and a small RRIF between you, your TFSs, even small ones, are the single best place to hold every spare dollar, precisely because they are invisible to the clawback that would otherwise hit you hardest. The principle is universal. The rules moved. Nobody told you. Whether you are a couple with a cottage and 6 figures in TFSs, or a couple living carefully on government checks, the same truth holds. The dollars you keep are the dollars you understood well enough to protect. Together, I want to slow down on each trap for a moment, because the mechanics are the difference between avoiding them and walking straight into them. Start with the age amount phase out, because it is the one couples trip over without realizing it. Picture a couple whose combined income looks fine on paper, but one spouse's individual income lands a few $1,000s over the $46,432 line. Their furnace quits in November, and they need $8,000 to replace it. The natural move is to pull it from whichever RIIF is biggest, usually the spouse who worked the longer career. It feels harmless. It is their money. But that $8,000 does 3 things at once and that spouse's return. It gets taxed at their marginal rate. It pushes them further past the age amount line, shaving more off the credit. And depending on the province, it may nudge other income-tested benefits too. The $8,000 furnace does not cost the household $8,000. Once you count the tax and the lost credit, it is closer to $10,000 or $11,000. Had the couple pulled $4,000 from that RIF and $4,000 from the other spouse's TFSA instead, the damage would be roughly half. Same furnace, same warmth, very different tax outcome, and the decision of whose account it comes from is one almost nobody runs the numbers on. And now, the OAS clawback, because the survivors trapped, deserves a closer look, and this is the one item on Doug and Carol's list that is still sitting open. A couple, both around 70, each receiving full OAS, with combined income carefully split down the middle, so neither is anywhere near the $95,300 Nickfried onward line. For years, their OAS is completely safe. Then one spouse is gone. The surviving spouse inherits the other's RIF, rolled over tax-deferred, the HUME part of the rule, but the larger RIIF now generates larger mandatory withdrawals, landing on a single tax return against a single threshold. The income two people used to share is now concentrated on one. The surviving spouse, in the hardest year of their life, crosses the clawback line and watches a chunk of their own OAS get taken back, on top of losing pension splitting, on top of a higher single filer tax bracket. This is not a rare edge case. It happens to a large share of surviving spouses, and it is almost never explained in advance. The defense is to plan for it now, while both of you are here and both thresholds are available. Draw down the larger RIF more deliberately, and build up both TFSAs as the cushion that will protect whichever one of you it eventually falls to. I said earlier that the system is not built to inform you, and I want to show you how that plays out, because it is not abstract. It happens every filing season. Picture a man, 71, who has used the same tax preparer for a decade. Every spring, he gathers his slips, sits down with whoever is free, and signs what is put in front of him. This year, the preparer, processing dozens of returns a day in the crush of the season, runs his return the way he always has. He does not stop to ask whether a withdrawal could have been timed differently or split between accounts to preserve more of a credit. He is not a bad person. He is a busy one. The man leaves having paid a few $100s more than he needed to, and he will never know, because nothing on the return is wrong. He simply did not capture value that was sitting right there. Multiply that by millions of Canadians filing the same way every year. For many of them, 2 returns at once, his and his spouse's, and you start to see the scale of what quietly goes uncaptured. Not fraud, not a villain, ordinary, indifferent machinery. It was never designed to hand a couple anything they did not ask for by name on either return. That is the real lesson underneath all 5 rules. The changes themselves matter: the rate, the age amount, the clawback, the capital gains certainty, the TFSA room. But the deeper thing is realizing the responsibility is yours, as a household. Once you internalize that, you start doing the small things prepared couples do. You compare both returns side by side, the way Duck and Carol did. You ask your preparer a pointed question at both of you instead of just signing. You check both TFSA contribution rooms before December. You decide together whose account a withdrawal comes from, instead of defaulting to whoever has the bigger balance. None of these moves is complicated. None requires being wealthy. They require knowing the lines exist on both returns and the habit of looking before you act together. $1 drawn from RRIF and $1 drawn from a TFSA buy exactly the same groceries, heat exactly the same house, fund exactly the same life. But one of them counts toward every threshold in this video on someone's individual return, and the other is invisible. The couple who understands that difference and plans around it together keeps thousands more than the couple who never thinks about whose account the dollar comes from. On the rate cut, the couples who benefit most are those whose income sits squarely in the first bracket, below roughly $58,500 each. If that is both of you, nearly all of your income enjoys the lower rate already. On the age amount, the most common mistake is one spouse taking a large RIF withdrawal in December without checking whether it pushes them over the $46,432 line. If a large withdrawal is needed, consider splitting it across 2 calendar years or splitting it between spouses' accounts, so neither individual return crosses the threshold. On the OAS clawback, because the threshold is per person, pension income splitting between spouses using Form T1032 is one of the most powerful tools you have right now, while both of you are here to use it. For couples, this is not optional. It is the core defense against the clawback today, and the foundation for protecting whoever is left tomorrow. On capital gains, now that the rate is locked at 50%, the smart move is to plan the disposition of an appreciated asset deliberately, and if it is jointly owned, remember the gain typically splits between both of you, which already softens the impact. Spread it across years where possible, so it never spikes her individual income into a clawback or phase out in a single year. On the TFSA, the most underused couples strategy is the deliberate RRIF to TFSA shift, done in whichever spouse's name keeps both individual incomes lowest. If one of you has a lower income year, draw a little extra from that spouse's RRIF, pay the modest tax, and move the after-tax amount into either TFSA. You are permanently converting taxable, threshold counting money into tax-free, invisible money, and building the cushion that will matter most the day one of you is filing a loan. Do those 5 things together, and you will have handled every change the CRA made this year without telling either of you. Doug and Carol are a real kind of couple, but the exact numbers are an illustration. Yours are different. Your province, your combined income, your home, your accounts, your ages, all different. The 5 rules are universal. What they are worth depends entirely on your specific household. So before you act, run your own numbers together and bring them to a qualified professional who can confirm how each one applies to both of you. 2 quick questions, because your answers shape what I cover next. First, which of these 5 changes did you and your spouse have no idea about until right now? Drop the number 1 through 5 in the comments. If it is more than 1, drop them all. The change that comes up most becomes its own full video. Second, have you and your spouse ever actually run the survivor scenario? What happens to your OAS and your tax bill the day one of you is filing a loan? Type yes or no. I read every comment, and that one tells me how many of you are ready to act before it is forced on you. If even one of these 5 was new to you, the system did exactly what it was designed to do. It kept you in the dark. The best way to fight that is to make sure the people you love are not in the dark either. So if this was useful, hit the like button and subscribe so the next change does not slip past you, and send it to a couple you know who is still paying the CRA more than the law requires. I know a lot of you are pulling up your CRA accounts right now, and I always say, talk to a qualified tax professional about your specific situation. But if you live in Ontario, do not want to do all that we talked about today by yourself, and would rather work with a professional for your tax planning and investment management, scan the QR code or click the link in the description to see if we are a fit.